Now, the only reason the OCR was on hold today was because Governor Bremen voted for no change. Now, she's the casting vote in a split decision.
Kia ora, and welcome to a special reactionary episode of the New Zealand Property Market Podcast, brought to you by Cotality on the 27th of May 2026. I'm Head of Research Nick Goodall, and I'm joined by our Chief Economist Kelvin Davidson. Kelvin, the OCR is on hold, but fair to say only just, as we saw a vote between hold and a hike. Not unexpected, I suppose, in terms of the ultimate result and the fact there was some significant discussion about it, but certainly intriguing nonetheless. Look, we haven't had long to digest this time around, so it's been a frantic sort of 40 minutes of going nuts on what we can read, and there's all sorts in there. So what is your early take on the statement and, I mean, importantly, the forecasts or projections, I should say, within the statement itself?
Yeah, I mean, there was a lot to read, put it that way, and a lot of interesting stuff, including the vote. I think the vote will probably get a lot of the immediate coverage. So yep, they kept the OCR on hold today. I mean, the vote. So this is a new thing, releasing the individual voting records of the MPC members, and it was a split decision. 3 voting for no change today, 3 voting for a rise. They all had different arguments around sort of how much second round inflation might emerge, what the balance is between price pressures and the weakening economy, and there's a lot of good discussion around that. But it was a split vote. Now, the only reason the OCR was on hold today was because Governor Bremen voted for no change. Now, she's the casting vote in a split decision. So I mean, it is as close as you can get to no increase today as possible. So that I think will get a lot of coverage. I mean, lots of they obviously changed the forecasts a lot in terms of economic projections, inflation projections, OCR projections. There's a heck of a lot to digest in there. They brought in 3 scenarios, so there's a lot of lines and numbers. But I mean, in the central scenario, yep, they've got a worse GDP outcome. That's not surprising. GDP growth's been downgraded. It's maybe not terrible, like it's probably perhaps not as bad as I thought it might be, but it's definitely downgraded. Unemployment rate set to stay kind of where it is now for 12 months, 18 months, around sort of 5.3, 5.4, so that's not great. Headline inflation has been revised up. They've now got that going above 4% in the next few quarters. Non-tradable sort of stays kind of steady, but it's that tradable thing pushing up towards 6%, things like fuel and imported goods and materials and things. So obviously, all of that's above the 1 to 3% target, so no surprises that the OCR projection was revised up as well. And I suppose, when I look through it all, there's a lot to digest, but a couple of really key things for me: that vote, split decision, and the OCR track has been revised up. And if you look at the numbers, it's a wee bit murky because they do quarterly averages, but just the way the timing for the next meetings fall and their quarterly averages for the OCR, it looks pretty likely that we hit an OCR of 2.5 at the next meeting. So in other words, at the next meeting in July, it looks pretty likely they're going to raise that OCR. After that, there might be sort of a couple more over the next sort of 3 to 4 meetings, but I think the timing for that first increase probably has been pulled forward to July. Now, there is obviously those conflicting views on the committee, as we just talked about, but yeah, it's those are probably the 2 killer points for me. And there's lots of economic projections, inflation projections, all of that. They actually think now that house prices are going to be well within the sustainable range. So certainly a pretty flat housing market outlook. That's a sort of a subsidiary thing to all of this, really, but that's in there as well, that they're not concerned about the housing market at all. So yeah, that's the key points for me. As I say, a lot to digest, but that's kind of what jumps out at me. I think there's definitely OCR rises coming. I suppose, is it July, is it September? I think based on this, you're kind of leaning towards July. So we'll see how the markets react.
Yeah, I think that's absolutely true in terms of, expectation now has to be set for July. What did you say? The quarterly average was 2.51% and there's only one decision in July. So, the projection says it all. Now, it is a projection, not a forecast. So it's where they expect it to go, not necessarily where they are going to go. And it is dependent, and I think, once again, this is where it comes back to us going, we're just trying to figure out what we think the Reserve Bank will do. I said on Monday that I've firmly got into a position where I don't think they should have to go in July, but it doesn't matter what I think. It's more about what they're saying they're going to do and us reading that. But I do think there's enough in there for those that are looking for, some of the justification that they might go on hold in 6 weeks' time again too. I've just taken a few direct quotes from this, and they said something like this. It was like, underlying inflation has continued to gradually ease, with measures of core inflation declining on average to 2.3%. So that's when you take out those volatile items, right? Like the core inflation figures are actually looking okay. And so again, there's reason here to say, well, if it doesn't roll through to high second round inflation impacts, then maybe they don't need to do as much as they are kind of projecting. And I do think that, there's some contradictory stuff in here, and maybe that's a reflection of, the internal staff that put together the full statement as opposed to the committee and some of the detail we're seeing from them. I did see Brad Olson tweeted not long after, focusing on the point that you did around the vote being split 3-3. He noted that it was the internal members that voted to hold, and it was the external members that voted to hike. And obviously Bremen, yep, she's internal, so she got the deciding vote there. So whether that says too much, I'm not sure. Maybe it does say that the vibe at the Reserve Bank itself is that, they're less worried about those second round impacts, and that's kind of how some of the statement reads. But then, yeah, the I don't know, the way they expressed some of the voting concerns and definitely the projections show something else. There was also some stuff around there about, they do want to await the hard data, as we say, which is those core tier one stats, I guess, GDP, CPI inflation, labour market stats, official labour market stats. They want to wait for that hard data to assess the impact on the second round inflation. So, yes, there are some those higher frequency indicators showing that maybe it's not as bad as they expect, but they want to really see that in the harder data. And I think that's fair enough too. Like they do want to be sure about this. And so they're going to wait to see as much and as good data as they can before they preempt anything that's going to happen down the track. What else have I got here in front of me? You probably talked about this, the annual headline inflation is expected to increase to a peak of 4.3%. But again, that's the headline inflation, affected, yes, by these short-term volatile things. That was by September this year. But then to return to that target midpoint in mid-2027. But I guess it's only going to return there with their projected OCR increases coming through as well. So that's not going to happen by itself. That is with their intended projections going ahead. And yeah, like I said, there's this line, while shorter term inflation expectations have increased, medium to longer term expectations remain close to 2%. So again, there's medium term inflation expectations remaining closer to 2%. So again, you go, well, if that does play out, then we do have to, maybe expect that they don't need to do as much as some expect. I've got a few more things, but I might just pause there if there's anything else that that triggers in your mind or you want to cover off before I jump into a couple of others. One of the other things I looked at, which I'll talk about shortly, is they did have a statement in there or a paragraph on their expectation of the potential length of the disruption of the Strait of Hormuz, which could also be a useful one to talk about. But yeah, back to you for a second before maybe we can look at that and close this out, because yeah, as we talked about on Monday, I did say I wonder whether they're going to put some scenarios in there, because it is so uncertain. So I can look at that in a second. But yeah, any thoughts, mate? Any further thoughts?
Yeah, I suppose just the reason why those three committee members voted for an increase today, it's really, they're not necessarily saying we need to get to a higher peak eventually. I guess their rationale was simply, let's just move a bit sooner. It's there, I think what is it, the stitch in time saves 9 or something. So you kind of move a bit earlier, which then potentially saves you having to do more later. That's part of it. Now, yeah, there's genuine concern about second round inflation coming through and the uncertainty and all of that. But it's sort of a preemptive thing. Doesn't necessarily mean we need to end up with higher rates ultimately. It's just you get there sort of faster. So that's sort of the rationale. I guess people might be wondering about what this means for mortgage rates. That's the other thing stemming from that for me. I mean, keep in mind mortgage rates have already moved ahead of this decision, and I'm not sure that the pretty strong intent that they do plan to raise the OCR at some point is really a surprise. Markets have been anticipating that anyway. So, maybe we see mortgage rates go up off the back of this, but, it need not be dramatic. If we only end up with a peak OCR a bit above 3, sort of in that 3 to 3.5 range. And mortgage rates have probably moved a little bit ahead of this too. So if that happens, it may be that mortgage rates don't necessarily spike. There's probably some upside there, but they don't necessarily spike. So that's something kicking around in my mind as well. But yeah, it's there's definitely challenges for the housing market from all of this anyway, and I'll change our sales forecast that we've talked about on previous podcasts, but kind of looks like very roughly, very very quickly, we're probably looking at a pretty flat year for sales, pretty much unchanged from last year, with flattish house prices as well, or even slightly down. So yeah, the housing market's sort of peripheral damage in all of this, but it's looking pretty sluggish.
Yeah, it's a great point, right? And yeah, if you look at the OCR track change, yeah, it is, the peak is a little bit higher, but it is about bringing all those increases further forward, and certainly a steeper curve. So it is like more confident that things going to come earlier rather than later. As you said, though, and real impact to mortgage interest rates, maybe not as great. So like you say, maybe no major reason to panic with that one. And yeah, on house price forecast, yeah, their house price forecast is slightly negative, and for longer too. They don't really have any house price growth coming through for a couple of years now. So I suppose there's potential for persistent weakness in the housing market, which, as we always say, isn't necessarily a bad thing anyway. If we look at some of the potential for economic growth, I think there was a line in there that said, the forecast of their GDP, they do indicate a slower economic recovery in the near term. So obviously weaker growth, over the last quarter and this quarter we're in now, than previously expected, and also a weaker economic recovery. But they did have the pace of economic growth increasing by the end of this year, which I thought was pretty optimistic, and it will be determined by what happens with the disruption in Iran. And I've got this full quote, which was: pricing in oil futures markets is consistent with a resolution to the conflict over coming months, and shipping resuming through the Strait of Hormuz. However, given damage to energy infrastructure and the need to rebuild inventories, oil prices are expected to remain elevated over the medium term. And so I guess, just trying to read through that to go, what's their expectation on how long the disruption goes for, and therefore what disruption or what influence is that having over some of their projections. This is still expected to go for a couple of months, but not longer necessarily either. So not expecting a resolution tomorrow or next week, but in the coming months, not, 6 months down the track. So I think that's an interesting one. And again, probably it's a central scenario. They do have those different options that they expect could happen. So it's worth considering that. But it still feels maybe on the side of optimistic in terms of some of that economic recovery, from my perspective anyway. The other thing, obviously, from an uncertainty perspective, for anyone on my uncertainty watch, we had seen this gradually reduce through the recent, 5 or 6 monetary policy statements, from sort of 80 in May last year, 67 to 32, 25 in February. This jumped back up to 52. So, certainly much more uncertainty than we had in February or November last year. But still not quite as bad as we saw a year ago in May last year, when there was 80 references to it. So, I don't know what that says necessarily, but again, it just shows that, there's really no clear path here. There's going to be very clear watching of, fast moving data and solid hard data, as well as they call it, before we really know what's going on. So yeah, intriguing one, no doubt about that. Plenty to watch. In terms of things coming up, we've got GDP data coming up next month, June, for Q1. So that'll be important to see what actually happened with the economy. We've got CPI data for Q2 coming in late July. So, a couple of months away for that, and Q2 labour market data is a bit further down the track in August as well. So not all of that will be before the next decision, but certainly those faster moving data sets they'll be keeping track of as well, to really get a feel for that second round impacts, because I think that's really what it comes down to. How do they read this? How do the different committee members read it? And then, of course, how their vote's going to go in that July one. But I agree, it's moved from more than live at 50-50 to something closer to, I don't even know, 80% chance of an increase, 20% not, something closer to that anyway, maybe even higher than 80%. Yeah, that'll pretty much do it for my thoughts. Calvin, you got anything to round us out, mate, before I do our outro?
No, that's it. That's it. I'll take a second round to digest it, but I think it's OCR rises are coming.
Second round's all round. Yep, and look, we'll talk about it again on Tuesday, not Monday, because of the public holidays. So we'll definitely use the next few days to digest it again. You mentioned you might, take a little look while you're waiting for the State of Origin to kick off tonight. So I think that's good use of your time. Late kickoffs, of course, over there. But you'll definitely have more to say on Tuesday. We've seen market reaction too, which I think is always important. So No, that's awesome, mate. Well, thank you as per usual for your thoughts. I know I rushed you to get this out, having to be somewhere shortly myself. So thank you for that. And just want to say thanks very much for listening. Please do make sure you subscribe to the show, hit that auto download button. So when we do the special ones like this, you are notified. But that'll do us for today. My name is Nick. He's Kelvin. You've been listening to the New Zealand Property Market Podcast. Mā te wā.